28-year-old Marcus thought he had it all figured out. He was tracking 47 different stocks, checking 12 investment apps every morning, and spending 3 hours a day reading market analysis. His spreadsheet had more colors than a rainbow, and he genuinely believed complexity meant success. Then one day, he checked his portfolio after a year of this madness and discovered something that made his stomach drop. His returns were actually worse than if he'd just thrown his money into a simple index fund and forgotten about it. But here's the twist that nobody talks about. While Marcus was busy playing investment chess with 47 pieces, his neighbor Janet was quietly building wealth with just 3 simple moves. And by the end of this video, you'll understand exactly why simplicity beats complexity every single time. Here are 9 secrets to simple investing that often get lost in the constant noise of meme stocks, sensational headlines, and flashy returns. And they could even save you $500,000. Most people think successful investing looks like a Hollywood movie. Multiple monitors, flashing numbers, and split-second decisions. This image has poisoned how regular people approach investing, and it's costing them serious money. Here's what actually happens when you overcomplicate your investments. You start trading too much. Every news headline becomes a reason to buy or sell something. This constant activity creates trading friction. All those little fees and taxes that eat away at your returns like termites in a wooden house. But the real killer isn't the fees, it's the psychological damage. When you're tracking dozens of investments, you become emotionally attached to each one. You buy high when you're excited and sell low when you're panicked. It's like trying to drive while looking at 47 different mirrors. The investment industry loves this complexity because confused customers are profitable customers. They can sell you expensive products while quietly draining your account through fees. And there's something even more sinister happening that most people never realize until it's too late. What if I told you that 3 simple investments could outperform most professional money managers? This simple strategy has consistently beaten about 80% of actively managed mutual funds over the long term. The 3-fund portfolio splits your money between just 3 things: a total stock market fund, an international stock fund, and a bond fund. That's it. No complex analysis, no trying to time the market. Just 3 funds that give you exposure to essentially every major investment in the world. Put 70% in US stocks, 20% in international stocks, and 10% in bonds, and you've created a diversified portfolio that would make most financial advisors jealous. You own pieces of thousands of companies across the globe, from tech giants in California to manufacturing companies in Germany. While other people are constantly adjusting their portfolios or panic selling during downturns, your 3-fund portfolio just keeps chugging along. It's like the difference between a reliable Toyota and a high-maintenance sports car that looks cool but breaks down constantly. And we're just getting started on why simple beats complex when it comes to building real wealth. Dividend investing sounds magical, living off payments companies send you without ever selling your investments. But here's the harsh reality that dividend enthusiasts don't want to hear. When you focus solely on dividend-paying stocks, you're putting all your eggs in a basket with serious cracks. Companies that pay high dividends are often mature businesses that aren't growing much anymore. They're paying you today because they can't figure out better ways to grow their business tomorrow. Would you rather own a fast-growing tech company that reinvests profits to double in value every few years? Or a utility company that pays 4% annually but barely grows? Over the long term, that growth company will make you much wealthier. High-yield dividend stocks often cut their payments during tough times. Remember 2008? Banks paying hefty dividends suddenly stopped paying them altogether. People who thought they had reliable income streams found themselves with worthless investments and no cash flow. Those covered call ETFs might sound sophisticated, but they're essentially trading away your upside potential for current income. You're selling your lottery tickets before the drawing for a guaranteed smaller payout. And there's an even bigger problem with focusing on dividends that most people never consider. Regular dividends are taxed as ordinary income, meaning they get hit with your full tax rate. If you're in a 22% tax bracket, Every dollar of dividends only puts 78 cents in your pocket after taxes. But growth stocks that don't pay dividends, you only pay taxes when you choose to sell, usually at the lower capital gains rate. This creates a sneaky wealth transfer that compounds over decades. Getting $5,000 yearly in dividends while paying 22% taxes means handing over $1,100 unnecessarily each year. Over 30 years, that's $33,000 in extra taxes, not counting the growth you missed. High-yield REITs are even worse. Their dividends are taxed as ordinary income at your full rate, with no qualified dividend breaks. You're volunteering to pay maximum taxes on your investment income. Meanwhile, someone with a simple index fund portfolio controls exactly when they pay taxes by choosing when to sell. They can harvest losses, donate appreciated shares for tax benefits, and pass investments to kids with a stepped-up basis that eliminates capital gains entirely. This tax efficiency alone can add hundreds of thousands to your net worth over a lifetime. But there's another hidden cost of complexity that might be even more expensive. When you own just a few broad index funds, rebalancing becomes almost automatic, and this simple process can add significant returns over time. Say your target is 70% stocks and 30% bonds. After a great year for stocks, you might find yourself at 80% stocks and 20% bonds. Smart investors rebalance back to their target, forcing them to sell high and buy low automatically. This rebalancing bonus might seem small, but studies show it can add 0.5% to 1% to your annual returns over long periods. On a $1 million portfolio over 30 years, we're talking hundreds of thousands in extra wealth just from this simple maintenance step. With complex portfolios of individual stocks and specialty investments, rebalancing becomes a nightmare. You'd need to track dozens of allocations, figure out tax implications for each trade, and somehow maintain target percentages. Most people give up and let portfolios drift, missing these benefits entirely. The real magic happens during market crashes, and this is where simple portfolios show their true strength. Every few years, the market has a complete freak-out session. Stock prices plummet, news anchors look panicked, and investors make terrible fear-based decisions. But if you understand simple investing, you'll actually start looking forward to these crashes. When you own a simple 3-fund portfolio, market crashes become shopping opportunities. Your regular monthly investments automatically buy more shares when prices are low through dollar-cost averaging. Instead of trying to time the market or figure out which stocks will recover first, you just keep buying the entire market at discount prices. Complex investors suffer during crashes because they're constantly second-guessing themselves. Should they sell tech but keep utilities? Rotate into defensive sectors? Buy gold or crypto? All this analysis paralysis leads to bad decisions at the worst times. Simple investors have a huge psychological advantage. When you own the entire market through broad index funds, you know crashes are temporary, unless human innovation stops forever. Since the S&P 500 has recovered from every crash in history, simple investors sleep peacefully while others lose their minds. If you invested regularly during 2008, you bought shares at massively discounted prices that made you wealthy over the following decade. The same happened during every market downturn throughout history. And there's one more advantage that might be the most important of all. All that time you spend researching stocks, reading analyst reports, tracking 47 different investments, and worrying about market movements? That's time you're never getting back. Life is short, and spending 3 hours daily managing investments means trading your actual life for the illusion of control over your money. You could be with family, pursuing hobbies, building your career, or doing anything that brings joy. Simple investing gives you ultimate luxury, time freedom. Once you set up your 3-fund portfolio and automate monthly contributions, you're basically done. Maybe an hour yearly for rebalancing, that's it. The rest of your time is yours. This psychological freedom has real value beyond money. When you're not constantly worried about investments, you make better decisions elsewhere. You're more present with family, more focused at work, and generally happier without the stress of trying to outsmart the market daily. Most importantly, simple investing prevents costly emotional mistakes that destroy wealth. When your strategy is boring and automatic, you can't panic sell during crashes or get greedy during bubbles. You just keep steadily building wealth, and this leads to something truly magical over time. When you're not paying high fees, not trading frequently, not getting cute with complex strategies, and not making emotional mistakes, every dollar you invest has maximum chance to compound and grow. Compound interest is like a snowball rolling downhill. It starts small, but as it picks up snow, it gets bigger, and as it gets bigger, it picks up even more snow faster. Your investments work the same way, creating an accelerating cycle that builds enormous wealth over time. But compound interest is incredibly fragile. Every fee you pay, every unnecessary tax, every bad investment decision disrupts the compounding process. It's like taking chunks out of that snowball as it rolls downhill. The damage looks small at first, but over decades, it can cost hundreds of thousands or millions. Simple investing protects compound interest like a fortress. Low fees mean more money stays invested. Tax efficiency means you're not giving unnecessary chunks to the government. Emotional stability means you're not disrupting the process with panic moves. The math is almost unbelievable. A 25-year-old investing $500 monthly in simple index funds earning average returns will have over $1.3 million by 65. But if fees, taxes, and poor decisions reduce returns by just 2 percentage points annually, that same person ends up with only $800,000. That's a $500,000 difference just from keeping things simple. Marcus eventually figured it out. After years of complicated strategies and constant stress, he threw in the towel on complexity. He sold all 47 stock positions, closed most investment accounts, and put everything into 3 simple index funds. Today, 5 years later, his portfolio has outperformed his old complicated approach by a significant margin, but more importantly, he got his life back. He spends evenings with family instead of analyzing earnings reports. He sleeps peacefully during market volatility instead of checking his phone constantly. And he's building real wealth through the boring but effective strategy of buying and holding diversified investments. The investment industry wants you to believe that building wealth requires complexity, special knowledge, and constant attention. They profit from your confusion and benefit from your mistakes. But the truth is simpler and more powerful than any marketing pitch they can create. Real wealth comes from starting early, investing regularly, keeping costs low, and having patience to let compound interest work its magic over decades. Everything else is just noise. Sometimes the most profound truths are also the simplest ones. And when it comes to investing, simple isn't just better. It's the only strategy that consistently works for regular people building a secure financial future. Your money doesn't need to be complicated to grow. It just needs time, consistency, and the wisdom to ignore everything trying to convince you otherwise. If you found this video helpful, check out our other videos on simplifying your personal finance.